The Bank of England just held rates at 3.75%, and most headlines buried the most important word in the entire announcement: peace. Iran war peace prospects are now part of the official macro calculus for one of the world's most influential central banks. That is not a small thing. When geopolitical risk starts appearing in rate decisions, it means the people managing the cost of money are no longer confident in their own models. So here is the question you need to answer before the cycle is over. Are we watching the beginning of a coordinated global pivot? Or is this the last quiet moment before a very disruptive repricing? Let's start with what a hold at 3.75% communicates, because the decision itself is almost less important than the context surrounding it. The Bank of England did not cut. They did not hike. In central bank language, a hold is a statement of uncertainty, and uncertainty, when it is this specific, is worth decoding carefully. The headline language connecting the rate decision to Iran war peace prospects is significant. Central banks rarely volunteer geopolitical context in their policy framing, unless that context is actively influencing their forward guidance. The fact that the BOE is publicly tethering its stance to developments in an active military conflict tells you something precise. Energy price volatility and its downstream inflation effects are still live variables in their model. Peace prospects mean potential energy price normalization, and if energy normalizes, the inflation picture in the UK shifts, which means the next move has more room to be a cut than a hike. Here is the analytical frame that matters. The BOE cut rates earlier in 2026 from higher levels, holding at 3.75% now, against a backdrop of potential conflict de-escalation, suggests they are in a wait-and-see posture. Gathering data on whether geopolitical tailwinds will do some of the disinflationary work for them. That is not weakness. That is optionality preservation. Central banks that move prematurely in either direction during geopolitical inflection points tend to look wrong within 2 quarters. The BOE is avoiding that trap. The actionable insight here is straightforward. Watch the Iran situation as a leading indicator for BOE policy, not a trailing one. The next rate decision is already being written in the Middle East. Now layer in what Goldman's Kaplan is signaling about the Federal Reserve, because this is where the macro picture gets genuinely interesting, and where institutional money starts making asymmetric bets. The Bloomberg headline is direct. Goldman's Kaplan says the Fed may hike by fall and sees risk of more. That is a materially different posture from what the BOE is communicating. One of the world's most systemically important central banks is holding in a wait-and-see mode, potentially leaning toward cuts if geopolitical conditions improve. Meanwhile, a Goldman strategist is publicly flagging that the Fed may be moving in the opposite direction, toward additional tightening by the fall of 2026. If both of those things happen simultaneously, you get a meaningful transatlantic rate divergence, a widening spread between U.S. and U.K. rates. That spread matters because it influences capital flows, currency dynamics, and the relative cost of doing business across the Atlantic. A stronger dollar relative to sterling in a divergence scenario is not speculation. It is the mechanical output of interest rate differentials driving carry trade positioning. Now, to be precise here, this is analysis of a stated view from a Goldman strategist, not a Fed announcement. The Fed is not hiked. This is a forecast with risk attached. Kaplan's own framing acknowledged downside risks to that call. But sophisticated macro investors do not wait for confirmation. They position on probability-weighted scenarios. The question worth asking right now is, if the Fed and the BOE are heading in different directions for the next 2 quarters, which assets benefit from that gap? And which assets are priced as if divergence is not possible? That mispricing is where the opportunity typically lives. This is not financial advice. It is the analytical question your portfolio needs answered before fall arrives. There is a layer of this story that most financial commentary skips entirely because it requires connecting dots across disciplines that most analysts stay siloed within. Let's close that gap. Geopolitical conflicts, particularly those involving major oil-producing regions, create what economists call a risk premium embedded in energy prices. When a conflict escalates, oil supply uncertainty drives energy costs higher. Higher energy costs feed directly into headline inflation figures. And central banks, whose primary mandate is price stability, then face a particularly uncomfortable dilemma. Do you hike to fight inflation that is being driven by a supply shock you have zero control over? Or do you hold and risk inflation expectations becoming unanchored? The BOE's decision to hold at 3.75% while explicitly referencing peace prospects suggests they may be betting that the supply-side pressure is about to ease on its own. That is a significant analytical bet. If peace negotiations in the Iran conflict genuinely progress, energy markets could reprice substantially. Brent crude moving even $10 to $15 in either direction has measurable effects on UK inflation data within 1 to 2 quarters. The BOE appears to be building that scenario into their optionality. For the Fed, the calculus is different. The U.S. is a net energy exporter in 2026. Energy price normalization from Middle East escalation is not necessarily disinflationary for the U.S. economy in the same way it is for the U.K. If anything, lower oil prices could compress energy sector earnings and GDP contribution, while services and wage inflation remain stubbornly elevated, which is precisely the environment where Goldman's Kaplan-style hike call makes internal logic. The actionable synthesis. The BOE and the Fed are living in different inflation realities right now, shaped partly by geography and energy exposure. That structural difference, not just the politics, is what is driving the divergence. Understanding the mechanism is how you distinguish a trade from a guess. We opened asking whether this is the beginning of a coordinated pivot or the last quiet moment before a repricing. The answer, based on everything in this analysis, is neither. It is a deliberate divergence. The BOE is threading geopolitical optionality into its hold. The Fed, according to Goldman, may be tightening into fall. That gap is the story. The follow-up question worth watching: what happens to emerging market debt if the dollar strengthens into a Fed hike cycle while commodity prices fall on Middle East de-escalation? That is the next video. Subscribe so you do not miss it.